Okay, everybody. So I know you want to know, how do we turn $6,000 into $1 million? Okay. I know you want to know this information. And so we're going to use this handy dandy calculator here. And I want to tell you guys the inputs that we're going to put into this calculator. So we've got a $6,000 initial investment, like we had talked about before, the lump sum investing. Okay. I'm not going to put any money in the monthly contribution for right now. And we have an estimated interest rate of 8%. Now, why did I pick 8%? Because I'm assuming that we're going to be investing into the S&P 500 and we're going to be getting the market returns. Okay, we're going to get the market returns, which is going to, on average, give us 8% per year. I have the length of time in terms of years at 0 because I don't want you to see how long it's going to take yet. So on the next screen, just take 5 seconds for you to just guess, how many years do you think it'll take to get $6,000 to $1 million? Okay, everybody, the results are in 67 years, you will have $1 million. Now, you may look at me and you say, Devon, I don't have 67 years to make $1 million. And trust me, I understand it. Unless you're investing for children that have just been born or for unborn children that have yet to be born, nobody that is watching this video or listening to this in podcast form have 67 years to get $1 million. But this is the one thing I need to put in perspective for you, okay? The reason why it takes you 67 years to get $1 million is because you didn't add any more money to the account. You didn't add any more money to the S&P 500. And so you didn't give yourself an opportunity to take advantage of the compound interest, right? Compound interest is simply the interest that your interest makes, okay? Albert Einstein put it like this: compound interest is the 8th wonder of the world. He who earns it makes it. He who doesn't pays it, right? So in order to take advantage of the compound interest, you have to do the thing over and over and over again. So again, it took us 67 years to get to $1 million. What if we change this monthly contribution to just $100? How long will it take us to get to $1 million? So if we added just $100 per month, okay, it would take us 51 years to get to $1 million. That's a 16-year difference. So that cut down 16 years on the time that it would take for us to get to $1 million. Now, remember this again, the monthly contribution. The monthly contribution is very, very key. This is something that you would have to do every single month. And that's what's so important about this compound interest, okay? 51 years, okay? So what if we change the contribution again? And I'm going to change it one more time. What if we change it to $500? Where would that put us? If we change it to $500 a month, that would bring us all the way down to 34 years, okay? And it would give us $1 million, right over $1 million at 34 years, right? So the first chunk, the $100, took us down 16 years. The $500 a month brought us down another 17 years. So what am I trying to really get you to understand? What I'm trying to get you to understand is that this monthly contribution is very, very important. You have to continue to put money to work, okay? One $6,000 investment, one $10,000 investment, one $25,000 investment. I would argue that you get the most out of it when you actually put more money to work, okay? Let me give you an example. A lot of people in the stock market love to give the dot-com bubble as an example, right? Okay, what was the dot-com bubble? The dot-com bubble was when a lot of internet companies and a lot of technology companies in 1999, 2000 went up, had these crazy returns, and then they fell off a cliff and they crashed, right? One famous company that did that was Microsoft. Microsoft crashed during the dot-com bubble. And it took Microsoft, I want to say, anywhere from 10 to 13 years in order to get back to the price that it was at the dot-com bubble. Why do I bring that up? The reason why I bring that up is because people on social media love to say, if you would have invested $1,000 or whatever into Microsoft, It would have took you 13 years to get that money back. The problem that I have with that statement is that if you were a long-term investor and you are investing into Microsoft and the stock fell 90%, and after the stock fell 90%, you still believed in it so much so to where you still held it, and you held it, and you held it for 13 years until it broke even, you have got to be crazy to not have added money to your position. Here's the thing, y'all. When you buy a stock, it's going to be very, very rare that you are going to buy that stock. It's going to go up as soon as you buy it and you never go negative. It's going to be extremely rare for you to never go negative on a stock. And so if a person that bought Microsoft during the dot-com bubble and it crashed 90%, but they still believed in Microsoft, they would be doing themselves a tremendous disservice if they did not continue to add money to the stock. What if they added $100 per month into Microsoft back during the dot-com bubble, and in 2013, where would they then be? Because their average price wouldn't be way up here around the dot-com bubble. It will be somewhere closer to that bottom price, somewhere closer to there. They built that position. Now they can just enjoy it and just ride to the sunset, right? So again, what am I trying to say? What am I trying to reinforce? What am I trying to say here? The monthly contribution is very, very important. One more thing I want us to understand, right? Another thing you got to understand too, it's taking us so long to get to $1 million because of our monthly contribution and because of our interest rate, right? I have the interest rate set at 8% for a reason. I have it set at 8% because I'm just telling you all that this is the expected market return. And this is just what you can get if you don't want to put any work in. If you just want to put money in and just let it ride, the S&P will give you their returns. Like the S&P will do that for you. That's what index funds are designed for. Index funds are designed to match the market's return. But I'm going to tell you, if you commit to the stock market, like if you really truly commit to the stock market, you can get 8% very easily. It's not going to be that difficult, but it's going to require research. It's going to require time. It's going to require commitment, right? That's what it's going to require. And so this interest rate is very, very important. And so let's say you commit to the stock market. Let's do an example. Let's say I don't have an initial investment of $6,000 because that $6,000 investment just might be too daunting for you. And I don't want to put 6,000 up there and just leave it up there, because I want you to understand that you don't got to have $6,000 to invest into the stock market. You can start with zero. It's all about the monthly contribution. What are we willing to put into the stock market and consistently put it there? Not just put 500 there and not touch it anymore. Okay, if I can only do $100 a month, do 100, and continue to work and continue to build and increase your skill set and find money. When you see the money working and you see it start to work, you are going to find money to put to the market. I promise you. So let's do an exercise. Let's say you were able to do $500 per month. Let's say you were able to put $500 per month into the stock market, for example. You can start with 100, whatever. I want you to say, hey, I'm shooting to get to a point to where I can put 500 into the stock market, and let's see what happens, right? And let's see what happens over a 10-year time span. And let's say my annual interest rate is 20%. Let's say I can average 20% in the stock market, because 20% is very, very good. It's actually great, actually, because most people will tell you that you can't get 20% in the market, and that's just not true. You have to be willing to put the research in and be patient enough in order to be able to get that 20%. But let's see, okay, if I have no money right now, I'm putting $500 a month in over a 10-year time span, 20% interest rate. Where would I be in 10 years? Okay, so in 10 years, $500 a month, 20% interest rate, you would have $155,752.09. Now, you may say, well, Devon, I don't have $1 million. I'm still about a little over 15% away from $1 million, right? But that's okay. But this is what I want you to do. I want to add context around the $155,000 that you got here, right? In a 10-year time span, you're going to experience at least one recession. At least one recession to where asset prices are going to drop 20%, resulting in us going into a bear market, right? If you're actually committing to the stock market and you're actually doing your research, you're going to find some stocks that you can buy that are on sale. If we go into one bear market, over a 10-year period and the S&P drops 20%, there's going to be some stocks that you love that you've been trying to buy for a long time that have probably dropped about 50, 60%, probably. Maybe even 70%, depending on what you're trying to find, right? What if this happened in year 5? What if we had a bear market in year 5? You've contributed $30,000, and let's say you've got about $32,000 in your portfolio because of the bear market. What if you did some portfolio reconstruction and you just moved some money around and you put some money into some investments that you believed in, that you knew were on a discount, you took advantage of them, you had a great return? You'll probably be way above 155,000 at the end of the day, right? Because of the fact that you were continuously putting money into the stock market. What is my point of all of this, right? The point of all of this that I want you to understand is that, number one, it's about the monthly contribution, right? The monthly contribution. How much money am I putting into the stock market, okay? Number two, the estimated interest rate. Don't allow anybody to tell you that you can only get 8%. Because if you tell yourself that you can only get 8%, guess what, y'all? You're only going to get 8%. And number three, 500. You may not be able to start with 500. You only may be able to start with 100. And so let's change it to 100. Let's do this exercise one more time, because I want y'all to see, where can we be at 100? Y'all, even at $100 a month, at a 20% interest rate, you would still have $31,000, over $31,000, which is more than what you started with. Because if you're starting with $100 a month, you're learning, you're getting into the game. But I'm telling you, don't be pigeonholed to this number, because yes, it's a theoretical number to kind of show you what's possible. But at the end of the day, it's about how much can you contribute. How much do you think you can get in terms of a return, okay? At the end of the day, guess what? You control how much you can contribute. You control what your interest rate is going to be. Why? Because you control your skill set. You control what you get up and do every single day. You control your career. You control what skill set, like I said, your skill set you're going to get. Right? In order for you to be able to get monthly income, in order for you to be able to be solvent and put money into the stock market, you control your interest rate, because you control the amount of research that you do. You control what industries you follow to see which ones are going to be the ones that are going to win in the next decade. You control that. You do not have to relegate yourself to the 8% that they tell you about all the time. Okay. That is just a baseline to get you into the game, to let you know what is possible. Now it's up to you to make a decision to say, hey, am I just going to accept this theoretical compound interest calculator? Or is the compound interest calculator only here to show me what is possible? And now I have to make a decision on whether I'm going to put the work in, how much money I'm contributing, and what interest rate am I going to choose for myself in order to see how successful I'm going to be in the stock